In a previous video I had put up in talking about agency, AGNC, which is a mortgage REIT that I own. I mentioned that I would be playing the options on this one, the calls and the puts, depending on where the price of agency went, and I was asked if I could expand on what that strategy looks like, so I'll do that. And then for the second part of this video, I'll show you a risk reversal trade on the S&P 500. It's on the SPY, the ETF that tracks the S&P 500 that I put on today. That's suitable for me, that I'm comfortable with. Now, what I'm going to show you is something I'm comfortable doing. That does not mean that I'm recommending this stock, nor am I recommending the strategy that I'm showing you. I'm simply showing you how to use the options in conjunction with a position that you have to increase the income that you would normally get. And stocks that have a measurable book value per share, that tend to hold very close to their book value per share, are great candidates for this. And typically, you can double your dividend in the year. So whatever the dividend is, you would manage your options throughout the year to double the dividend. So let me set this up for you. On the screen, you see a one-year chart of AGNC. And before the sell-off, let's just draw a line at where approximately its book value per share was, which was between $17.50 and $18. So if we just draw a line across there, there was book value per share. So you can see for the most part, it traded at a discount to its book value per share, and only in the final stretches here before we sold off did it trade at a premium. But all REITs exploded at about that time and traded well above their historical range, and dividend yields were falling on a bunch of REITs to the point where it was, well, you know, the dividend on the REIT isn't as nice as it used to be. I was lightening up on a lot of REITs at that time because the yield was simply too low. So it doesn't get to premiums too often, which is nice. So if I simply moved this up to the $18 mark, which is right about there, and let's draw another colored line here, and we'll put another one down around $16. There's $16.50. There's $16. So in this period of time over here, let's get rid of this. In this period of time throughout here, I didn't own agency. I really wasn't interested in it at that time. I thought that the equity REITs were a little bit better. But if I had owned it during this period of time, that is how I would have played it. I would have been selling calls at the 18 on a monthly basis, waiting for those to expire, then selling the next month's calls at 18, and I would have been selling puts at 16. Being perfectly willing to buy the stock if it was put to me at 15, and as you can see, it would have been put to me probably in August and September. I would have been assigned some shares, but the dividend was nice, 16 cents a share. I would have been comfortable owning more agency. So what am I doing at this point in time? When I sell the call, I would wait until the stock, and I don't try to sell them every month. There are some months where it doesn't make any sense to sell the call or sell the put. I want to sell the call when agency does this, when it starts to approach the call price, because my premium here will be nice and big. So I want to sell this call for anywhere from 40 to 60 cents per share. And I want to sell puts every time it approaches the lower band, and that's where my premiums will be the highest down here. So I would have seen this as an opportunity to sell puts. I would have seen this as an opportunity to sell calls. I would have been selling puts here. I'd still be selling puts here. I would have been selling calls all along here. And I'm not trying to do it every single month. I'm just looking at agency. At this time, it was 16 cents. It was $1.92 a share dividend. I would have said, well, that's my goal for the year, is to generate another 92 in selling options. So if I'm getting 40 to 60 cents on the calls and I'm getting 40 to 60 cents on the puts, I really only have to do it anywhere between 3 and 5 times a year to double that dividend. Now, I had said in a previous video, and I ended up getting way more email than I thought I would ever get on this comment, but I said that you don't necessarily have to, graduate from school, get the charter, and then go work for a large organization. You can look at the market as an entrepreneurial venture and treat it like you would any startup. And because the market is full of opportunity. If you have a skill at recognizing opportunity, there's no better place to be than the market, because it is full of opportunity. You just have to develop the skill in how you actually execute on that opportunity. And I got a ton of email about how do you actually do that. And what I just showed you is exactly what I do. You position yourself to get on base. You're not swinging for the fences with every bet. You're saying, I want to hit singles. That's all I want to do. I want to generate some income because I need income, and I want to hit singles. That's all I'm looking to do. And then I will use other strategies to increase that income. When I hold agency, if I was holding during this period of time, I was generating $1.92 a share per year in income. And all I wanted to do was generate a little bit more. Which means double my dividend. Now, at $1.92, this was trading around $18. You're talking about 11% yield. So with the dividend and the options trading, you can get 20 to 24% per year on judicious buying and selling of options. And again, you're not looking to get it done every month. The beautiful thing about this game is you don't have to swing at a pitch unless it's right across the plate and you know you're going to get on first base. That's all you're swinging for each time, first base. You generate a lineup of a whole bunch of these with a mix of strategies that you use, and you just keep sending each one onto first base. The home runs come in on their own. So let me show you what I would do with agency at this point, and I'll back up some of the writing that I have on the screen at this point so that we have a clearer screen to work with. And let's draw our lines. We were told with agency's update about a week and a half ago, 2 weeks ago, that their tangible book value per share, their net book value per share is $13.60. So if we go to $14, and let's draw our line at $14 because that's where I would be selling the call, anywhere above 14. If conditions were right, and only experience tells you this, and I saw agency come to 13, but it looked weak. I didn't see the volume supporting that move to 13. I would sell a $13 call because I'd probably get really nice premiums. But being that its book value per share is $13.60, I'm selling calls below its book value per share. I run the risk of having that called away from me, and I don't want it called away from me. I want the income from the call. I don't necessarily want it called away from me. So I'd be willing to sell the $14 calls. And at this point, I'm more than happy to sell the $11 puts. The dividend has been cut. It's no longer 16 cents a share. It's now 12 cents a share, which translates to $1.44 a year. On $11 is still about 11 to 12% yield, and if I play the options right, I can get that to 22 to 24% per year income, even if agency goes nowhere. And here's the thing about it: when I find a stock that I can do that with, I really want that thing to go sideways. I don't want it to go up and have it called away from me and have to rebuy that position. I don't want to play that. I want it to go sideways. I want it to be a very low volatility stock. The options over time will decrease in value, but if they leave me enough space that I can double that dividend, that's income. That's what you're working for. You're working for a paycheck at this point in time. You want that income. So I have sold the $14 calls and I have sold the $11 puts. I sold the 11 way back here when it was still breaching $11, and I've got well over $1 for it. But the $11 call, the $11 puts. I'll show you the options chain in a second. I'll show you what the premiums are today. We're right in the middle of the range over here. So we're sitting right between the 11 and right between the 14. What am I going to do? I'm going to let the price action tell me what I'm going to do. If tomorrow this pushes up a little bit higher, well then I will sell the May 14 and be quite happy. If this tomorrow pushes a little lower, well then I will sell the $11 put for May and be happy. So let's look at the types of premiums that it was offering today, being in the middle of the range. We'll look at the premium, so you can imagine as it goes closer to the put strike, the premium would increase. Let's have a look at that. So here we are. Here's an options chain on agency. I don't need that many strikes up. This is for May 15th, which is in 24 days. And I'm looking at the 14 call, 12 cents to 25 cents. So if I put something in the middle at 18 cents, well, again, the monthly dividend was 12 cents. This is 18 cents. That's not bad. If I look at the $11 puts, they're 30 to 39 cents. That looks a lot more interesting than selling the $14 call. Now, when I sell the put, it means I'm perfectly willing to take on a larger position. So I've got a 3,000 share position in agency. I don't mind adding to it. I don't mind adding 500, 600 shares a month over the next year. So I don't mind selling those puts. So I'll sell 5 or 6 puts this month. If I don't get them assigned to me, that's fine. I'll double the amount of puts I sell next month because I would have bought 500 anyways. And I'll just keep doing that till they're assigned to me and get my position. But if this pushes up towards 14 tomorrow, these premiums will increase. The 12 to 25 will increase. I'll be more than happy to sell $14 calls at that point on half the shares that I own. So I'd probably sell 15 contracts at the 14. If it pushes down towards 11, we got 30 to 39. If I can see getting 50 cents to 60 cents on the premiums, I might go as high as 10 contracts on that one. And that's what I would do. I would let the price action each month dictate what I'm going to do. If it's in the middle of the range, I can wait. I can wait because over time, if you look at a stock over a period of time, it's very rare that it flatlines. It'll move up and down. When it moves up, sell those calls. As it moves down, sell those puts. But you got to be prepared to buy them if they're put to you. I don't mind buying a stock that pays me an 11% yield. Agency just cut its dividend. I already did a video on their press release, so I'm not going to go over the fundamentals of it. It's enough to say that I'm comfortable owning it, and I'm comfortable owning more. If I get an opportunity, if there's stress in the market and this thing pushes down, that's great. I don't see it really pushing down very much. The price action today in the market was negative. I think all 11 sectors in the S&P were negative. Agency was higher. Agency squeezed out, I think, a 3 or 4% price increase today. So it's going up when the rest of the market is going down. That tells me that if we get an up day, agency will probably move up towards the 14. I'll get to sell the call. So that's how I'm going to manage that position. And I don't mind the 3,000 share position growing to 6,000 or 7,000 shares over the next 12 months. I'm comfortable with that position. This may not be appropriate for you. This particular stock may not be appropriate. But the strategy I outlined may be appropriate on a stock that you find appropriate for yourself. Let's look at a risk reversal on the S&P 500. All right, so on the screen, I've got a 1-year chart of the SPY, which is the ETF that tracks the S&P 500. And I'm going to show you a risk reversal. And I can do a risk reversal on the futures, on the ES, on the S&P minis. I don't like doing that because the underlying, if I am assigned, the underlying does expire. Whereas with the ETF, if I am assigned the underlying, I don't mind owning the underlying because, as you can see at the bottom of the chart here, it pays a quarterly dividend. The yield on the S&P is typically around 2%. Even at this lowered value, you're going to have lowered earnings, but you're still going to have a dividend yield on it. I don't mind owning something if I'm going to get paid to wait. So yesterday I had made the case that the S&P could at this point find a home somewhere between 27 and 2,900, and I also made the case that if we saw a lower multiple on lowered earnings, we could see 2,500 on the S&P. So let me set up what a risk reversal is. A synthetic long position using options means we're going to sell a put and we're going to buy a call at the same strike price, which means if you add up the two deltas, you'll get a delta very, very close to 1, which is a delta, the delta of the underlying. So you should earn the same amount on your synthetic long position as you would if you owned the underlying, with significantly less capital required to get that done. So take this, remember now we sold the put and we bought the call, and just separate them. So we're still going to buy a call, but we're going to buy a call at a higher strike price, and we're going to sell a put, but we're going to sell it at a lower strike price, and we're going to work it out such that the premiums on them are very close to the same, such that it costs us $0 to get done. And depending on how you structure it, you might even get paid. I did a risk reversal today, and I'll show you the two strikes, and I got 80 cents a share. So I just took an opening position of 5 contracts, or 5 on either side, both legs, on a risk reversal. So I got paid $400 to put that trade on. So let's look at what I did. I took my position, or at least my thinking, that you could see 2,500 on the S&P, and I went down to 249, and that is where I sold the put. Now I needed a call. So whatever the premium was on the put, you simply just start walking up until you find a call with a premium very close to it, and it was at 290. So let's move all the way up to 290, and there is the call. So I sold a put, and when you sell a put, you get money. You take that and you buy the call for the same dollars, which means you have 0 cost. You're still going to need margin, but the securities you have in your portfolio will act as margin, and if you have a certain value in your portfolio, you will be entitled to portfolio margining, which means you really, for me, when I put this on, nothing was affected. No margin was affected because I had the securities that would act as margin on this. So this was basically a free position for me to put on. The portfolio delta of this one here is 0.75. When I say the portfolio delta, the combination of the two together gives me a delta of 0.75. If I had taken the call and the put at the same strike as the SPY, I would have a delta of 1. I got a delta of 0.75. Now, as this moves in either direction, that delta will then begin to increase, because it will, remember now I've sold the put and I bought the call. So as it increases, my call will increase. As it decreases, the put will begin to increase and the call will begin to decrease. So basically, and this is for September, I did the September options on this one because I wanted enough time for reality to kind of show up on this one. We have a push to reopen the economy, and I think that's going to keep some buoyancy to the S&P for a while. And as things start opening up and companies start issuing better and better guidance, I think that it will give support to the market. Yesterday I was saying that this big leg down here, that was a liquidity event. That was a lot of selling based on liquidity. We can see that it quickly recovered, and here we are. We're sort of near the I wouldn't say we're midway between the upper and the lower strike. If by September 18th, if I hold these right till expiration and the S&P is anywhere in here, that's it. Both options will expire worthless, and since I got paid to put this on, I get to keep that money. If the S&P finishes above here, well then I get dollar for dollar whatever happens above that point. And if we're down below here, it will be assigned to me. But then again, I don't mind if it's assigned to me below 249 because it does have a dividend yield. Now, could the S&P drop significantly below that? Yeah, it could. It could keep dropping. But if it did, then I would put some other trades on to begin to minimize that loss. I wouldn't just sit there and say, "Oh well, I'm really getting hurt on this one." I would engage in risk management at that time. Until then, I'm comfortable with that. So that's what a risk reversal looks like. It is a bullish trade on the S&P 500 using the SPY. I have enough downside over here all the way to 249, and the upside is 290. That's roughly about equal to where the S&P 500 would be if you add a 0 to it. So 290 is roughly about 2,900 on the SPY. 249 is roughly 2,490 on the SPY, which is where the value that I got to yesterday using a lower multiple, a bigger hit to corporate earnings with a lower growth rate into 2021. I got to, not a lower multiple. I still use the multiple of 18, but I used a lower corporate earnings for this year and lower growth into 2021, and I got to 2490. That's how I chose the lower strike. There's a risk reversal.